If you are sitting on 100,000 and wondering what you can do with it, after all, fixed deposit rates are at its all-time low, and you're wondering if there's any investment that you can invest and get better return with your money, if that's you, or you just want to know how you can invest with 100,000, this video is for you. Hi, welcome back to Mr. Money TV, your favorite financial edutainment channel, bringing you financial education and entertainment at the same time. So, what are you waiting for? Subscribe to our channel and turn on the notification to get updated with our latest video. And don't forget to follow us on Facebook and Instagram as well. Firstly, congratulations for making 100,000! You are probably thinking, what can you do with this 100,000? What are some of the things that you can invest and grow your money? More importantly, how can you invest 100,000 ringgit? Before you start investing with 100,000, the first and most important step is to make sure that you have an emergency fund. Emergency fund is important because one thing we can be sure in life is that there is always going to be changes and unexpected events. So you want to be prepared for this. The last thing you want is to get caught unprepared and you need to liquidate your investment prematurely for emergencies. So, what is a good amount of emergency fund to have? Ideally, you should have at least 6 months of expenses in your bank account as an emergency fund. If not, try to have at least 3 months of expenses as an emergency fund. So, if you have not carved out an emergency fund, please do so before you start investing with the 100,000 ringgit. After setting up an emergency fund, it's time to educate yourself about money and set realistic goals. While some would say that educating yourself about money and setting goals are two different things, I think otherwise. In my opinion, your money education and financial goals are interconnected. It is something that goes hand in hand. People can only set goals for things that they know. For example, a native living in rural jungle will not set goal to be a tech entrepreneur. He probably doesn't even know how to use a computer. So we can only set realistic goals when we understand money. Setting realistic goal or expectation for your investment returns is very important. In my 10 years of experience, I've met many people who lost a lot of money because they did not set a realistic goal and took on huge unnecessary risks leading to losses in their capital. On the other hand, I've also seen many who did not want to learn more about investment and decide to just keep all their money in their bank account, only to complain later about the low returns they are getting from it. So, take some time to learn about money, understand how money is created, what are the different financial instruments like bond, mutual fund, ETFs, stocks, and so on. You don't need to be an expert in each of them, but it's good to have a general understanding and knowledge to know how it works and how it can benefit your wealth. With technology, learning about money, gaining financial literacy has never been easier. You can search online for good articles and watch YouTube videos just like this one. And join us when we have live sessions on every Tuesday, Thursday, and Saturday. When you have a realistic investment return in mind, it is time to decide what are the investment vehicles that you would like to invest your money into. We would suggest you to diversify your investment into different investment vehicles based on your risk appetite. With 100,000, here are some of the common investment vehicles that are likely available for you. Money market fund. Money market fund is basically a unit trust that invests in overnight borrowings between banks. It is often used by high net worth individuals and corporations as an alternative to fixed deposit, as it is considered a low risk and high liquidity investment. If you would like to know more about money market fund, you can check out my video about money market funds from the link in our description or click the link here. Unit trust or mutual fund. It is basically a pooled investment vehicle that pooled the money of many investors with a common goal and invest it into a bunch of assets. For example, investors who want to invest into small and medium-sized Malaysian companies on Bursa Malaysia. So the fund manager will pool the money of all these investors and invest it according to their goal. A unit trust can be invested into stocks, real estate, or even commodity. This is suitable for investors who do not want to actively manage their own money but would like to have a fund manager to actively manage their investment for them, with a fee, of course. Again, if you would like to know more about unit trust, you can check out our video about unit trust in the link below or click here. Exchange Traded Funds, or ETF. It is similar to a mutual fund, but instead of having a fund manager who is actively managing the funds, this fund will be passively managed. This means that investors would just buy and stay invested over a long term. And the goal of an ETF is to simply match the performance of the index fund. The general idea is because ETFs are passively managed, so over a long term, the performance on an ETF will exceed the performance of more than 90% of the actively managed unit trust funds. This is because the fund manager of an ETF will make less mistakes. Well, because they just don't need to make much decision other than follow the index fund. So lesser mistake because of that. And also, the lesser fee that they charge their investor also save a huge amount that contribute to return to their investor. If you are interested to know more about ETF, you can check out our video about ETF in the link below. Robo-advisor. This is one option that is gaining popularity amongst the public these days. So, what is a robo-advisor? A robo-advisor is simply a digital platform that provides financial advice to the investors. Robo-advisor gives advice and allocate your investment into multiple ETFs according to the algorithm that it was provided. Please take note that it is not an investment asset. It is just a service provider like a human financial advisor. It simply helps you to allocate your money into different assets based on your risk appetite and investment goal. And at this point, most of the robo-advisors are helping you to invest your money into ETFs. Investing into individual stocks. It is arguably one of the most rewarding investment vehicles that an investor can choose. Just look at Warren Buffett. Who doesn't know him, right? A successful stock investor can make an average of 20 to 30% return a year over the long term. That means it doubles your capital every 4 years. However, it does come with a price. You need to spend time to educate yourself about the stock market and the company that you are investing in if you really want to be a successful stock investor. Once you have decided to invest in the share, you also need to have a strong discipline to control your emotions when the share price goes up and down. If you can do that, stock investment could be your ticket to growing your wealth on the fast track. If you would like to learn more about stock investing, do check out our video series on stock investing and subscribe to our channel. And on every Saturday, we have a live session called Talk Stock Sing Song, where we have a discussion about stock investing and take questions from the public too. Real estate. There's traditional real estate investment and also real estate investment trusts that you can invest in. The first is buying a property in hopes that the value of the property will appreciate or you can earn from rental from the property. Property investment need you to fork out high amount of money to pay the down payment, renovation, and upkeep and maintenance of it. You also need to be sure that you have the cash flow to be able to pay for the installment for the property. Traditional property investment comes with a high risk as it is not liquid. Selling a property is a matter of months or years before you can receive your money. Nonetheless, it can be very rewarding if you know how to manage it well. Alternatively, you can invest in REITs, which is like unit trusts, but it's investing into real estate and managed by a professional manager. REITs investor may not enjoy huge capital appreciation, but it does provide a steady stream of income for investors who prefer a steady income from dividend yield. Insurance. It is one of the most common investments that many investors would choose to invest in. While investing in insurance product may not give you the kind of returns that a mutual fund or stock market provide, it has its benefits. Firstly, if you took a plan that has a payer benefit, in the event if you are diagnosed with a critical illness, the insurance company will pay the premiums for you. Also, there is a guaranteed payout when the investor passes away. This often allows investors to leave a huge sum of money for their family when they pass away. Therefore, in my opinion, insurance is more of a suitable tool for estate planning and wealth distribution. So, with an understanding of some investment vehicle, you can now allocate your investment according to your risk appetite and your investment goals. If you would like to start with a reference point, here's one for you. Subtract your current age from 100. That's the percentage of your money that should be invested into equity. So, if you are 30 years old, subtract it with 100 and that would leave you with 70. This means that 70% of your money should be invested into equity-based asset. This could mean equity-based unit trust, exchange-traded fund, or individual stocks. So, if you have 100,000, this means that 70,000 to be invested into equity-based asset and 30,000 into bond or money market fund or just cash. Again, this is just a rule of thumb. It is important to assess your own risk appetite and your investment goals to allocate your investment. The truth is, a good investment portfolio that gets a great return comes with time and effort to to educate yourself to be a savvy investor. You need to be at least financially literate to be able to allocate your portfolio effectively and efficiently to reach your financial goal. If you are not willing to spend that time, you will need to depend on others to do it for you, namely financial advisors, where you have to pay an advisory fee or pay them in the form of commission for buying the financial products that they are selling. After you finish allocating your assets, whether through a DIY method or a financial advisor, you will need to monitor and rebalance your portfolio from time to time. Don't be mistaken that this means that you need to look at your portfolio every day and every hour. That's not how it works. All you need to do is probably track the performance of your portfolio once a month or once every few months. It is important to be informed and know what is happening to your portfolio, whether it is making profit or losing money. With that, you are able to make an informed decision along the way. So that's all about how you can invest with 100,000 ringgit. If you did enjoy this video, please hit the like button and leave a comment for us. And if we have missed out anything you'd like to share with us, your thoughts, share with us how did you invest your first 100,000. See you next time.